Okay, I hope you had a nice lunch. I thought it was wonderful what they prepared. What I wanted to do is just quickly wrap it up. I'll try to do that in about 20 minutes, half an hour, if that is okay, because you've all probably absorbed quite a lot of new information over the last 2 days. And then we'll have the final session on Q&As, whatever is still on your minds or things once you've seen everything that you want to come back on. The first thing is hopefully what the last panel, I just was listening in with them. You see, in fact, what quality of people we have that build those businesses. And we have now about 25 of those together. So if we can harness that quality of these people, we're actually creating one of these founders circles where they all come together and think about how that rubs off over time to the rest of the company and how that galvanizes change for the rest of our businesses. I'm actually very excited about. I just wanted to echo Graham very quickly on what he said yesterday night, to thank Andrew. Andrew and I have been on many roadshows, and you've seen us there as well. He's been a tremendous support to us in IR, and it will be a loss a little bit to me because I wouldn't. It's always difficult when you work so well with someone, and then what is life going to look like when the person is not there supporting you? Because all the things I was saying that were wrong, Andrew was always the one that corrected it. So now, who's going to correct me from now on? I'm really worried about that. But he is extremely, obviously, has had an incredible career, but extremely thankful for the contributions he's made to Unilever. So let's have another round of applause for Andrew. And then I do want to recognize Kevin as well. You've seen Kevin present yesterday. Kevin, obviously, running our refreshment business. I remember when I came into the business, lots of you had questions about our refreshment business and our ice cream business and some of the other things. You actually see how fine a business that is. On tea, we've moved rapidly to the premium side, where a market has really made a seismic shift, and Kevin has really taken that on. We got some great acquisitions with T2, Puka, and Tasso, which gives us into different segments, different channels, premium all, and that's doing very well for us. And you see in our ice cream business, which, without being overly proud, I would really say that's the best performing ice cream business in the world. And I'm happy to see that you all agree, because half of you are eating ice cream right now. But Kevin has done a tremendous job, and that business has given us 1/3 of the cash flow improvements, which have been enormous in absolute anyway. We've doubled the cash flow, more than doubled over this period. But over the last few years, 1/3 of that has come from ice cream itself. And this will be Kevin's last meeting as well, because he will retire from the company, or, I don't know. He will not use the word retire. I don't think that exists anymore. But I wanted to use this opportunity to thank Kevin as well. Is Kevin here still, or is he here? There he is. Kevin, thanks. So the last year has probably been a busy year, but then I try to tell everybody what's new. The pace of change has never been so slow, and it will only accelerate. And if you can't deal with it, you probably better look for something else. In our same building in 100 VE in London, there is the post office on the 3rd floor, and that's always a great analogy to use. But you really have to have people that have a little bit of a different stamina in today's world than probably yesterday's world, and that can deal with these changes and see in all of these changes opportunities. And I hope in the last 2 days, as you've heard many of our marvelous speakers, that you see how we have embraced at relative high speed these changes. And it's serving us well. If you look at the last 12 months, our shareholder return has been about 30%. More or less. If you then project that to the last 9 years, has been about 280%. I think we're able to cope with that, and because this company has seen a fair amount of change over the last few years, which I like. Even when I came in, there was a fair amount of change even before that. There is an ability actually to deal with that change quite positively and constructively and drive that change into action. If you then channel that in the right directions, you get the energy and the dynamism that hopefully you've picked up over the last 2 days here. And I'm very proud of that, to see all these people presenting this, because that's the core of the company. At the end of the day, I can talk to you about 1 million brands and some of the M&A activity, but it's actually the people that you see here that I believe still is our competitive advantage. So over the last 2 days, I hope you got a little bit of a feel of Connected for Growth in action. Last year when we talked it in Port Sunlight, it was a little bit abstract still for some of you when I talked to you about this, and now you've seen a little bit more meat around the bone. You've definitely seen in many of the different elements how it is fueling our top priority of growing our business. Sure, we need to be a little bit more on the volume side, which we think is coming in the quarters ahead, but it's definitely fueling our growth. You've seen how we become a little bit more courageous on innovations, bringing them faster to the market on our established businesses, launching new ideas. Many of the products on the tables in front of you that otherwise would have taken years are now being done in 6 or 9 months. So it's starting to come. As I go around the markets, I really feel that we've unlocked something that was trapped perhaps in the organization and trapped in many organizations, I would say, and that is coming out. You've also seen the stepped up activity around the 5S program that Nitin started on home care, that is now expanded and well embedded into the other categories as well. And it's really for us a source of funds that we can use for growth. And you see the same with ZBB and some of that Graham undoubtedly yesterday alluded to. And then finally you see that in this fast changing market, you can do so much yourself, which you obviously have to do. That's priority. You have to take care of your core businesses. But you then have to actually accelerate it with other activities. So the fact that we have now done 19 acquisitions since 2015, or even 10 acquisitions this year, and I believe very good acquisitions, really gives us this opportunity to actually accelerate this change and be very well placed for this future that we're facing every year more. Some of that will be in existing businesses and help us premiumize. Some of that will be to accelerate trends that we otherwise can't do alone, and some of that will be in some of the new factors that are future areas of interest to the company that might be important pillars for the company 5 or 10 years out. Now, the key thing that we have to continuously keep in mind, if the world changes so fast and if there are many disruptors now in every industry, including in ours, then the first thing you have to do is how do you build resilience in the organization. If the organization doesn't have resilience to deal with that, you just start panicking, and that's obviously not where we want to be. So we spent a lot of time on that. You also have to build speed and agility in the organization. It's undoubtedly the case that you cannot predict everything and every trend. I'm sure here in the US that Alfie talked about Halo Top as an example, where you see a competitor that has something that you didn't think of. Broadly, we are on trend now with most of our brands, but there are always some surprises there. But then you have to have speed in today's world. In the past, you could wait and muscle your way back in again. Now, if you miss something, it's much more punitive if you want to. And if you get something right, it's much more rewarding. And we'll see some examples of that. And undoubtedly, you've seen some of that as well. And then you have to have a clear point of view on what this future is that you want to create and the opportunities that you want to address. Now, I think we are doing that increasingly so in Unilever, and that's what gives us that confidence that we're sharing with you in the numbers and how we see the things unfolding and what we're promising to the market. Broadly, we've been fortunate on some of the trends that we saw, and they've served us well. That when we started the Unilever Sustainable Living Plan about 9 years ago now, the world was a different place. But the urgency of that plan, as you heard from Brian yesterday, to have more purpose-driven brands, to be closely connected into your value chain to some of these risk factors, to think about corporate reputation. All I can say is you can buy any newspaper now on a daily basis nearly, and you just have to open them to see that if you don't internalize these things increasingly so in your business model, you're putting yourself at an enormous risk, and that is happening, unfortunately, to too many companies on a daily basis. We've also moved early to the categories, the 4 categories that we established, to make something that is very big more agile, to not have one common denominator on our strategies, but to adjust these strategies for each of these categories, which frankly have different competitive sets and different drivers. If the question came, why can we now do prestige and feel comfortable about doing it well, or why do we now succeed in ice cream better than perhaps we did before? It is that because in a system of where we have it, we find this right balance. We try to find this right balance of leveraging that scale and at the same time having our unique core competences that are needed in each of these categories to win. And then The last thing is connected for growth. There's no doubt that the markets are bifurcating. It's an increasingly depolarizing world. Many of the local competitors are coming up. Some of you have referred to that. We need to be closer to consumers. It used to be that a trend would take longer to establish, or you could wait for 4 or 5 countries to have a global trend, and then you would roll out something. Now you see different things happening in different markets. Obviously, you focus on the biggest markets, but you need to be prepared, and you need to be very close to that. We have a benefit, I think, in Unilever by a little bit, not by design, but by default, is that we actually came from a very decentralized structure. We tried to bring a little bit order in the house and made it more centralized, which has served us well. But we still have the right elements of this entrepreneurialness and close to the marketness that you've seen here in North America, and undoubtedly Case talked and others, that give us this right balance. We call it 70-20-10. If that term was used in the last 2 days, but it gives us the right balance. Now, connected for growth is only actually accelerating that. So it has made the company more robust, and I think it's one of the reasons why you have now seen 9 years, if we finish this year well, knock on wood, but 9 years, and we still have 4 weeks to go, so I'm fairly accurate in my predictions right now, but not totally yet. But that would be 9 years of top and bottom line growth. That would be a total shareholder return of 280%, and that would extend the streak to 37 years, if you want to, of dividend growth on an average of 8% per year. Now, I don't think there are many companies that frankly can say that they've been able to do that. But having said all those things, there is no doubt with the speed of change that there is no time for complacency. We always need to be a little bit, as Andy Grove says, is paranoid. His famous book, Only the Paranoid Survive, is even more relevant now than when it was written, in my opinion. So we have to think about the future all the time. We have to think about where we want to go next. And we have to instill some things in the organization still to respond to that. It starts with nurturing the core. There's no question about it that a solid and growing core is the first and foremost priority for having a healthy company and a healthy Unilever in our case. We start from that already with some really clear strengths, or what I would call ownable properties, if you want to. And let me just remind you of those, because some of them have been talked about, but I just wanted to give you my vision on that. The first one is our portfolio of brands and shares and categories should not be underestimated. There are many companies out there with many brands, but not with the share positions that we have. A company that has 85% of its turnover now in number 1 or number 2 positions, not only globally, but in most of the markets in which we operate, is a very good position to start from. Every year, Kantar issues a study on the individual top 50 brands in the world, which is a study that everybody basically waits for when it comes out. In that, we have 13 of the top 50 brands. 13 of the top 50 brands, which compares to the next competitor, only has 5 in the top 15. Not only that, actually, we also have some of the fastest growing, what they call recruiter brands, which are new households coming in, which is a very important indicator for us. In the top 10, we actually have 5 of the top 10 brands that are the fastest recruiting brands. Brands like Dove, that have added 14 million households last year. Brands like Sunsilk or Fim or Sif, as you know it. Brands like Rexona. And believe it or not, even a brand like Brooksmont, our tea brand in India, is on fire. So, very well placed, including the categories itself. I believe that the categories we're now in, we've done quite a lot of category work over these years, and the categories that we're now in are pretty good, where we're leading the way. You take PC, which is a little bit over 20 billion euros, up from 12 billion euros about 9 years ago, 40% of the turnover of the company now, well positioned in the growth categories you want to be in personal care. You look at our home care business, which has doubled, a business that is now over 10 billion, again well positioned when urbanization, especially in the emerging markets, gives people access to kitchens and toilets, when increasingly the cities of this world are polluted, either with water or air. Our portfolio is a strategically fine portfolio. And then our food and refreshments, I don't need to talk about that, you've seen that as well. We've worked very hard to streamline that business and make that business more global. It's now 45% more or less in the emerging markets from memory. We obviously like to push that to the 60 or 70% in line with the rest of the company. But it's a very focused portfolio now. And the question now is how quickly can we transform it to what we call Food 2.0, and that process is underway. But the footprint is good, and the focus on the categories that we are is perfectly fine. Next to that, we also have, I think, increasingly embedded purpose in our brands that is becoming increasingly relevant. It's important to win the Advantage study or the Gartner study, where we are, as it happens to be, number one again in terms of customer service or supplying the customers in a country like this. But what is far more important, in my opinion, is the underlying equity or strength of the brand that comes from driving these businesses with purpose. Brian talked about it yesterday when he talked about Target and how important it was to attract the consumers already of today and certainly of tomorrow, which we conveniently call millennials, although it's a little bit more complex than that. If you look at GlobeScan, they issue every year a sustainability index, which I would say is probably the more important and relevant index in this world. And we are, for the 7th year already, number one on that index, and it really helps us with corporate reputation in all respects. If you look at the Carbon Disclosure Project, we are actually with only another company, and I mentioned that other company because I'm proud of that there's more than us, which is L'Oreal, but we are the only two companies on the top there, by far on the top, in terms of how we think about climate, how we think about water, how we think about forests. All these things are absolutely crucial in your business models as we move forward, to take risks away, to build reputation, to take costs out. And then in the Dow Jones Sustainability Index, I don't have to talk about that. We're now in the category of personal products, and we're doing very well there as well. So very strong share positions, very strong brands, and brands with a strong purpose. Then you look at the second reason why I like what we're doing is the geographic channel and portfolio breadth. If you want to give 9 years of stability, you have to be sure that the organization provides that opportunity to do that with the categories you're in. Sometimes one category will perform a little bit better, other times another category will perform a little bit better. We've gone through a little bit weaker period on personal care. When that is going better, we can afford perhaps to have another category, have a competitive attack that might give you something. But if you have the breadth and depth of the portfolio that we have, you can give these consistent results of outperforming the market year in, year out, including with the depth that we have in channel coverage and geography. There are very few companies, if any, in my opinion, in the world that really match what we are doing here. 60% now of our turnover, more or less, is in these emerging markets. And I personally still believe that that is the right thing. Undoubtedly, the emerging markets have a little bit been more difficult than we all thought collectively over the last few years. They've had their own issues. But as I said last year, and as we're starting to see increasingly, I think that they're addressing their structural issues, and it's a good time. If you think that in 30 years' time, or less than 30 years' time, 80% of the world population is going to live outside of Europe and the US, then you ought to focus on that if you believe in running your company for the long term. And if you just even get closer to home than the next 20, 30 years, and you just look at the next 10 years, you've seen some very striking statistics. All the growth in the world, the real growth, is actually happening behind urbanization, obviously, and in the emerging markets. 600 million people in the next 10 years will move into the middle class again. We have 900 million people that will be moving into cities in these emerging markets. And what I'm very pleased about is we have at least another 200 million women that will enter the workforce in paid employment for the first time. And that is obviously a huge opportunity. If you look at the emerging markets alone, I was just thinking about that coming in here and thinking of what to say to you. But in the emerging markets alone, if I compare it with the developed markets, for all the categories that we are in right now, the development index is probably 1/10. And I'm probably conservative saying that. 1/10 of what it is in Europe and the US, be it ice cream, be it deodorants, or be it any of the other categories. So the opportunities are enormous. On top of that, believe it or not, despite being in 190 countries, we still figure out some white spaces. We went into Myanmar. We got ourselves associated with the biggest consumer goods company there. We are now by far the biggest company, and that is well on its way, hopefully, It surpassed 100 million euros already and well on its way to becoming a billion-euro company like we did in Vietnam. I'm on my way as I leave here tomorrow, the US to Africa, and one of the countries I'll be visiting is Ethiopia, which is a tremendous opportunity. We just entered in there fairly recently. We have already 2 or 3 products that we produce on the ground, 50 million this year, 100 million next year type thinking, and you're off again to a business that could be having a potential of $1 billion or more. If I look at our brand presence, look at the brands you have in front of you. Look at the brands we just acquired on top of that. If I look at the brand presence and the map of the population in the world, again, I don't have the exact number of that, but I would be surprised if we cover with our brands more than 50% of the world's consumers. So giving access to our brands in many of the markets that we're in and increasing that range of brands is an enormous opportunity. What I'm trying to tell you with all of this, that growth is a mindset issue. It's nothing else than that. It's a mindset issue. If anybody worries can you grow in this new world with all these other competitors, are it only the locals that are growing or the globals? I think you're having the irrelevant debate. The opportunities are there, and the opportunities are there even more so than they've been there in any past time in the past. We reach 2.5 billion consumers a day. We reach 30 million outlets. Brian was talking yesterday, if I remember from his talk, about 30 million consumers that come into his stores. We have 30 million outlets. In our business, I prefer to have the outlets because there are a heck of a lot more consumers in that. We cover all the trade channels now and increasingly have a strength, obviously, that we've always had in our traditional channels or in the modern trade. But now we are actually getting that strength as well in the out-of-home channels, which are starting to work for us. The new retail channels coming up, the online channels that you're well familiar with. So opportunity enormous for all of us to keep growing there. Second benefit I just talked about is this enormous breadth of geography, channel, and portfolio. The third competitive advantage that we're obviously driving is our people. And as I talk about our people, I would always talk about our values as well. I would say that it's increasingly becoming more difficult to predict what issues we will face in the future. But what I can certainly predict is what leaders we want to solve them. And that is obviously where we're focused on in Unilever beyond anything else. Attracting the right talent, developing the right leaders. We are preferred employers in 34 of the 50 markets that we measure. And these are the bigger markets, not surprisingly. We get 1.8 million applications a year to be able to pick the best and brightest. We have strong local talents in all of the places that we operate. In fact, not only that, in our surveys we continue to see 91% of our employees are proud to work for Unilever. The country category business team structures that we've put in place obviously had reasons to be close to the consumer, move faster, empower. But it also is an enormous opportunity to develop future talents, to develop the future general managers, the future CEO. We're investing 100 million every year now in training. Our 4-acre centers that you have seen in Singapore or the one in London are obviously our key anchors of that. Interestingly, even in our company, people that what we call our active learners, which are people that participate very fast in these training programs, have a 33% higher chance of promotion, not surprisingly, and are also 92% less likely to resign. So people that survive in this environment are people that are able to learn new things very fast and unlearn the other things that are not needed anymore in the future. And I believe, again, when I talk to people and values, that our compensation plan has become even more robust than it already was. Longer term focused, more linked to performance, linked to our share price, a founder's mentality, performance driven culture is still being strengthened as we talk. And last and not least, I don't want to spend too much time on that, but our purpose-driven business model, or what I briefly talked about, our Unilever Sustainable Living Plan, is a driver for growth, as I've mentioned many times. Now, many surveys will point out that over 50% of consumers in all major markets want to buy products that are more sustainable and more responsible, especially the case for the coming consumers, or what you call the millennial generation. 85% of the people that now graduate from universities want to join purpose-driven companies. The USLP is taking cost out of the system increasingly as Mark undoubtedly showed yesterday. And on top of that, it is taking the risks away, especially in our supply chain, on some of the burning issues that we have to deal with, not least the planetary boundaries that are probably affecting any company. Interestingly now, I see companies announcing results, and they're starting to blame the weather. They're starting to blame the droughts or what we've seen in the US as well. If you are a company that is well prepared, like we are, rapidly greening our supply chain in terms of energy, or thinking of alternative sourcing. I'm about to go to Rwanda to open a new tea plantation. Or looking at water and water usage and thinking about that strategically, you actually make your business models more robust. There's no question about it. Now, having said all these things and having talked about some of the strengths that we certainly feel are competitive advantages over time for a company like this, every day more transparent, there are also some opportunities that we want to drive a little bit further. So one of the opportunities that I continue to focus on with our leadership team is obviously our innovation capabilities. There's no question that trends are emerging faster than at any point in time, and that we need to respond to that faster. And innovation next to people will always be the engine of the growth in this company. So we've never cut our R&D, unlike many people in our industry. We've actually strengthened our R&D spend. We've made our processes much simpler, as you've seen, to allow us for speed to the market. This year alone, we've halved the time to bring ideas to market. We've doubled the speed with which we roll out these things. Am I happy about that? Heck no. But now that we've halved it, let's have the discussion if we can halve again. Now that we've doubled the speed of rollout, let's have the discussion if we can double again. We've really built a tremendous partner to win program. I've always said there is more R&D and knowledge in our value chain than there is even in our own house. So with our biggest suppliers, under the leadership of Mark Engel, the category presidents, we really have put in place a find partner to win program where we get the best from each of our suppliers when they invent things. I want them to come to us first before they go to anybody else. Increasingly, we're getting the channel design in. As you will see, today it's the drug channel, tomorrow it's e-commerce, then it's something else. Increasingly, consumers want to shop when and where they think about fulfilling their needs. They are channel agnostic. They just want to get the products at the most convenient way. And increasingly, we have to design our products around channels, and that is a key driver of innovation itself, and you've seen some examples of that. We've created the Foundry, where young, new startups are coming. Actually, to the extent that in Singapore, now one whole floor of our building is occupied by foundry companies. Over 1,500 companies, directly or indirectly, linked to our companies. Not only do we get the wave of entrepreneurial spirit that blows over into our company, but we can also selectively pick some of the ideas that we can then test in our own value chains and hopefully run away with it. Our ventures that you're well familiar with, often giving us early visibility, especially in personal care and digital, where we've chosen to especially focus as the needs, obviously, in that area are the biggest. And then last but not least, our speedboats, as I call them, the 19 M&A acquisitions that we have done is a form of M&A. The whole world is trying to invent, so if you can associate yourself with some of these wonderful entrepreneurs that were just here on the panel, and actually they feel very, very good to be attracted to companies like ours, that's an innovation machine in itself. But we need to continuously strengthen that. The other area we worry about that we need to continuously strengthen is the organizational agility. Sure, we like to share with you that the organization has become faster, and sure, we have enough examples of that, but that's yesterday. Yesterday's tools to win are certainly not enough to win in tomorrow's market. We continuously have to look at how to make this organization more efficient. How can we introduce the Botanifiques or the Love, Beauty and Planet or the Key Juice or the rollout of Blue Air or the new Persil variant that you've seen, or in some other categories, the liquid bouillons or whatever you have. How can we do that twice as fast? I still believe that some of the new brands that we have acquired and some of these initiatives sure are faster than where we came from, but certainly the rollout is not fast enough for the world that we're going to live in tomorrow. The good thing is that Connected for Growth gives us some good feedback. 8% of the CCBT leaders now have seen a jump in speed, agility, and performance. In fact, the biggest jump that we've seen in our studies comes around bias for action, which jumped up by 21 points, which we've never seen before. So we are onto something with Connected for Growth without any doubt. But I think we're just scratching the surface still. Our 50 brand communities that we have, obviously, increasingly are able to better share with the needed speed the insights that we need to win with the consumers. Next to the organizational and innovation capabilities, I would also think about further work to be done on strengthening our portfolio still and our optionality for the future. As I said, it's increasingly difficult to predict everything, so you need to create possibilities. Some of them might work and some of them won't work. You have to be able to live with that. You'll be critical on the ones that don't work, and you'll take it for granted on the ones that work. But increasingly, you have to prepare your organization for these optionalities. Our 10 acquisitions just in this year alone are growing double-digit. In fact, our acquisitions itself, if you look year to date, are growing 3-4 times faster than the rest of the business. So we think that is a key driver for growth on top of that. The spreads, this divestiture, is on track as well and is part of managing this M&A portfolio, and we hope to conclude that obviously in the near future. And then the unification that Marijn talked about again yesterday during dinner so eloquently is another element of creating that optionality to be able to survive in a future increasingly unpredictable world. Now, what are our priorities? Very briefly, if I bring them into short, medium, and long term, as much as I can say about the long term, obviously. On the short term, 2018 will be a busy year. Don't feel sorry for us, but it will be a busy year. And I mentioned that as strongly to the people in the company as I mentioned that to you. We have to exit spreads. That takes a lot of work. You have your sunk cost. You have your organizational disruptions. We have to put the food and refreshment unit together. We have to integrate the M&A activities that we got this year. We have to accelerate our savings programs to be sure we deliver on the bottom line, and all of that whilst ensuring that we also give you the confidence that we can accelerate our volumes. So we are confident that we can get this 1% back from Connected for Growth that I believe this program is going to deliver in terms of the speed, in terms of the innovations and things we talked about. And increasingly also you'll see the other 1% coming through as the effect of changes in our portfolio that we've made. And that's why we feel confident that the direction is positive in that respect. C4G, we need to work on further improving our innovation pipeline next year, our agility, our execution. We need to embed firmly now the ZBB and the 5S and not have that a program that got its attention because we were under pressure or we had to do it, but that it is embedded in everything we do in our business. And then we have to be very smart in reinvesting. We've always said that 2/3 of these savings are actually fuel for growth. And we have to be very smart and very choiceful in where we invest that money. So that's what we have to do short term. Medium term, it's obviously a little bit longer and more strategic what you think about. And the first thing we have to do is be sure that we stay on track to deliver against our 2020 target that we set, and be sure that we embed this agility 100% firmly into the organization. We also have to be sure that we become a far more digital organization. I spent one day in New York with some companies in the beginning of this week, and there is no doubt that we are perhaps in a relatively good position, but it's changing so fast that what you think you're good at today, you might be obsoleted tomorrow. So how can we really become a truly digitally enabled company? How can we truly get our data-driven consumer insights? We have the 25 people data centers that we put in place. How can we truly get competitive advantage out of that? How can we reinvent truly the consumer engagements? How can we reshape, if you're Mark Engel, your asset and cost base to be more agile, more responsive, and become the real low-cost manufacturer? How can you digitize your distribution, your sales force, your e-commerce to higher levels? And how can you leverage that in some of the new business models? Questions to answer between now and 2020. If you look beyond in 2020 and beyond, obviously a little bit more difficult to predict, nor do I want to share everything with you. But obviously you need to think in this longer term time frame far more about your portfolios, your portfolio shifts, and to be sure that you're robustly placed in a world that will look fundamentally different. We also have to think about the supply chain. What does an end-to-end supply chain look like? What does it mean if you work under environments of lean, agile or shared asset models? How can we handle this complexity that undoubtedly will come in with hyper-fragmentation when you can customize nearly to each individual consumer? Can our supply chains, or what should our supply chains look like to be successful there? What is our employment contract with people? What will it look like to be the talent magnet in 2020 onwards? Making it a truly data-driven company and leveraging that in an area or in an era of robotics or artificial intelligence. How do you truly build these minimal 1 billion one-to-one relationships that we should be having? How do you create these movements for change out of these relationships so that people have a high love affection with your brands? Now, there's still many things, obviously, that we need to work on in these different time frames that we will stay focused on to stay ahead of the game. And then there are always things that keep us awake at night, although I always tell people my best advice is to sleep at night so that you can do the right things during the day. But for the ones that are awake at night, there are some things that you might want to think about, because what normally got us here doesn't get us there anymore, and I think Darwin's theory is even more important today than it was yesterday. The winners and losers in this industry are increasingly clear. It's a little bit like digital and analog now. Everything now is basically the more binary, if I want to say. You're either a 1 or you're a 0. And obviously we don't think that we deserve, nor do we want to be a 0. So we have to stay very, very close to the fragmented consumers, understanding their needs, further building this founder mentality, empowering people to take decisions and take responsibilities that come with that. We need to also be sure that we continue to attract the right people and the right talent as we move forward, and that's always most on my mind. And finally, we need to do this by, in the company, still changing a lot of habits. Values will stay the same in Unilever. They're unchanged, I would argue, even from the time of Lord Lever. But the culture obviously needs to evolve. And you have to worry about that continuously, because you can make the best strategies and the best intentions around that. But if your culture doesn't adapt, then you won't get the results that you're looking for. So it's about culture, it's about talent, it's about staying close to consumers that are on our minds. Above all, though, I want to reassure you that we will keep the right balance to continue to deliver between the shorter term, which I would define on a 12-month basis, and the longer term. This is a model that is built on a value creation that we call a long-term, values-driven, compounded growth model. I continue to say that it works well for shareholders that are long-term focused. Sure, you can squeeze out always more short-term, but that is now increasingly proven with other business models that do that you have less value creation over the longer term. Even more important now that we think about our obligations towards our future generations, that we think about our obligations for retirements, that we need to invest against, that these long-term compounded growth models, which seem to become increasingly rarer in this world, are actually of far more importance if we want this world to function for everybody. For that reason, we are fairly confident to, again, reconfirm what we've said before to you, that we're now in this global economy that we're in the 3 to 5% growth range. You've seen some of these potential upsides if we fully embed the programs that you've been exposed to. We think that Connected for Growth will give us the 1% that we were probably missing in the last numbers, and that our M&A portfolio over time will give you the other percent that brings us more to the mid part of the range or to the higher end, depending obviously a little bit of what the global economy is going to do. We also want to confirm that we are on track to the 20% margin in 2020, which is a significant step change again from where we came from, that will result in 100% cash conversion at that time, up from 85%, I think, more or less where we are currently. And then interestingly, despite the M&A activities that we do, and some of we will continue to do, our return on invested capital, which has now become one of the major measures for our senior leadership in their rewards, as you know, our return on invested capital has continued to stay between the 18 and 19%. So despite the M&A, I want to reassure you that our strategy of acquiring the right assets at the right time, more or less, and then growing them fairly fast is actually a very good strategy to build shareholder value, and it has not come at the expense of our overall delivery of return in invested capital. With that, I know we've shared a lot with you. I want to thank once more all the presenters who have worked very hard to put these 2 days together for you again once more.